IVM.
Investing isn't just about numbers, charts, or strategies. It's also about you, your emotions, your instincts, and yes, your biases. Our brains are amazing, but they sometimes lead us astray, especially when it comes to money. I'm Parthush Anand, and welcome back to Season 2 of Finance Flashback, brought to you by ICICI Prudential Mutual Fund. Today, we're diving into the fascinating world of behavioral biases in investing. Those sneaky tendencies that shape how we make decisions, often without us even realizing it. Stick around, because we're exploring how these biases can impact your investments and what you can do to stay ahead of them, with a little help from history. Let's get into the biases one by one. Bias number 1, overconfidence bias. Let's start with something that feels good at first. Confidence. Now, confidence is great, but overconfidence in investing, that's a whole other story. It makes us believe that we're better at predicting market trends than we actually are. For example, many investors overtrade, thinking that they can beat the market. History has a classic example, John Law. In the 18th century, this economist convinced France to back his Mississippi Company, claiming it would bring unimaginable riches. His overconfidence fueled speculation, leading to one of the biggest economic bubbles in history. And when it burst, France was left reeling. The lesson? A little humility goes a long way. Instead of overestimating your knowledge, stick to a well-researched plan and seek diverse opinions. And remember, no one, not even the experts, can predict markets with absolute certainty. Diversifying through mutual funds can help you mitigate this risk by spreading your investments across a wide range of assets, sectors, and even geographies. Mutual funds are professionally managed, which means the fund manager uses their expertise to create a balanced portfolio tailored to specific investment goals. Whether the market experiences highs or lows, a well-diversified investment can provide a cushion against an extreme volatile situation, making it an essential tool for long-term wealth creation. Bias number 2, herd mentality. Next up is something we've all been guilty of, following the crowd. Think about it. How many times have you rushed into something just because everyone else was doing it? A trendy stock, a hot market tip, or even a hyped-up cryptocurrency. A famous historical example is the South Sea bubble in the 18th century England. Investors poured their savings into the South Sea Company, not because they understood its business, but because everyone else was doing it. Tragically, many lost everything when the bubble burst. What do you learn from this? To do your own research. Just because an investment is popular doesn't mean it's the right one for you. Stick to your goals and avoid jumping on trends without understanding them first. Bias number 3, loss aversion. The fear of losing. It's so deeply ingrained in us that we sometimes hold on to bad investments longer than we should, hoping that they'll turn around. This brings us to ancient Rome. The grain dole, a policy of giving free grain to citizens, was hugely expensive. Even when it was clear that it was unsustainable, Roman leaders kept it going, fearing backlash if they stopped. Over time, it strained the economy. Let go of the emotional attachment. Regularly review your investments. If something isn't performing, it might be better to cut your losses and redirect your money to better opportunities. Bias number 4, recency bias. This bias is all about giving too much weight to recent events while ignoring the bigger picture. Take the California gold rush of 1850s. Stories of a few lucky miners striking it rich spread like wildfire, and thousands flocked to California expecting the same fortune. What many forget was that for every success story, there were countless failures. Don't let short-term performance cloud your judgment. Whether it's a stock, a fund, or a sector, always consider long-term trends and fundamentals before making a decision. Bias number 5, anchoring bias. Finally, we have anchoring bias, when we fixate on an initial piece of information even though it's no longer relevant. Consider Robert Falcon Scott and his ill-fated journey to Antarctica. His team relied on outdated maps and routes instead of adapting to new conditions. This anchoring to old information tragically cost them their lives. In investing, don't get stuck on the price at which you bought an asset or outdated expectations. Regularly reassess your investments based on current data, not past assumptions. So what's the key takeaway here? Awareness is everything. These biases, from overconfidence to anchoring, can cloud your judgment. But recognizing them is the first step to overcoming them. Whether you're investing in mutual funds, stocks, or even real estate, stay mindful, stay informed, and most importantly, stay curious. Thank you for joining me on this journey through the fascinating world of behavioral biases. I'm Paritosh Anand, and this has been Finance Flashback. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.